Hello, YouTubers, friends, compatriots, bootlickers, shills, desolators, peasants, vassals, hedge fund managers, hedgehogs, gamblers, buccaneers. Arr! I'm a useful idiot. Today I want to talk about hedge funds. Hedge funds kind of as the financial pirates of our day, because these are generally small companies built around an individual, and they're essentially doing all the same kind of crap that the investment banks do, the too big to fails, only on a personal level, with all sorts of perks and a lifestyle that would blow most people's minds. And this is a lot of the details are coming to light most recently because of all this insider trading scandal going on with SAC, Capital Advisors. And when you look at their record, it's pretty amazing. 30% return for 20 years in a row. So somebody out there explained how it is that you can have 30% returns for 20 years in a row without being a totally corrupt criminal operation. That's at the heart of my discussion of hedge funds. So I'm going to be skirting the issues and talking about hedge funds in very general terms because I want everybody to grip the simplicity of this financial model of financial piracy by these essentially freelancers. So 30% return for 20 years in a row. So if you invested $10,000 in 20 years, you'd have $1,461,920. That's a staggering rate of return. And this case brought out a quote that's in reference to another case in 2011. And it said that, quote, given the scope of all allegations to date, we are not talking simply about the occasional corrupt individual. We are talking about something verging on a corrupt business model, for the defendants seem to have taken the concept of social networking and turning it into a criminal enterprise. This is a business sector where information and speed are everything. So this makes a lot of sense. And they say the hedge fund industry as a whole is dominated by unethical maneuvers that sometimes are legal, sometimes borderline, and often criminal. And certainly we know that to be true. And in fact, this quote comes from a close look at the hedge fund industry that talks about the three signals of why we know that the hedge fund business model is utterly corrupt. And this was in an article called How Hedge Funds Create Criminals by Lynn Stout of UCLA Law School. And this is all going to be obvious to everyone who has just been watching the financial industry in general. But signal one is authority doesn't care about ethics. And we know that's true. The ends justify the means. And the big guys get paid the top dollar because they're willing to do whatever it takes. And a lot of this activity is criminal, but it's buried in so much bureaucracy and lawyer speak that people have a hard time seeing just how clearly. Plus, since we have a judicial system and a government and the banking system, they're all in collusion. Of course, they're not going to eat their young or go after their own. So, signal two, other traders aren't acting ethically. So that excuse that everyone's doing it, so if I don't, there's going to be a problem. And that's been proven to be true. Whistleblowers are generally shunned and fired. And this is the same way that we've seen everything else work, whether it's in the government or the private sector. And it also confirms something that we've seen as well, which is if one bank's doing it, they're all doing it. And signal two in the hedge fund industry and the financial industry confirms that. Other traders aren't acting ethically, so I might as well not either. And signal three is unethical behavior isn't harmful. So it's very easy for these hedge funds, and this includes the bankers as well, to distance themselves from the damage they do on the street to average people across the globe. They don't really care. They're just, for them, it's just good business. And misery is always good business. And we even have a confirmation from Jim Cramer, who is pretty much a media tool. With that said, he had an inside track at one point, and he admitted that the hedge fund game is built on one lie after another. And he said, quote, "If you're not willing to lie, cheat, and violate the law, then maybe you shouldn't be in the game." And the other part about this, too, that is interesting, and this is more example of a collusion with criminal enterprises, is everybody wants these hired guns, these buccaneers, these hedge fund managers, as part of their game. So colleges and public institutions and nonprofits, pension funds all want hedge fund managers on their board so they can get huge donations. And hedge fund managers don't let them down. They do make huge donations. So we have all this confirmation of how it is a criminal enterprise. So we've recognized that. And let's look at some of the details. We have portfolio managers in a hedge fund actually get a management fee from 1 to 4%, and then they also get a performance fee, supposedly 20%. But in reality, averages 10 to 50%. So they have large stakes in their own company. That's why they end up serving their own needs by basically screwing over their clients a lot of times. But think of the money when you have a hedge fund with, say, $3-4 billion in assets they manage, and they get a management fee of 1 to 4% on assets handled by their hedge fund, and then they get a performance fee from 10 to 50% on whatever their investment successes are, which is just insane amount of money. Collectively, the top 25 hedge fund managers earn more than all 500 CEOs of the S&P 500. Think about that for a minute. Collectively, the top 25 hedge fund managers earn more than all 500 CEOs of the S&P 500. We know the CEOs of the S&P 500 are generally overpaid as well. And this is kind of averages out because, as a matter of fact, there's over 4,000 hedge funds that are registered with the SEC. So I don't want to distort the picture that the big dogs are the ones that make the big bucks. And in fact, a lot of hedge fund managers don't make much if you're at the lower rung of the hedge fund community. And in 2011, the top earner got $3 billion. So but that's one individual. And the average is about 600 million, as it turns out. So still not chump change by any stretch. And of course, in 2011 at least, half of all hedge funds were offshore. So in 2012, the estimated size of the global hedge fund industry was $2.13 trillion. So once again, we have essentially 4,000 hedge funds, and they are responsible for $2.13 trillion industry. That's pretty staggering in itself. So that's why I want to talk about hedge funds. This is a huge amount of money. They have a huge amount to do with moving and shaking the market. So it affects all of us. And the fact that basically they play both sides, going up and going down. For example, this last week, the Dow has had some huge drops, and the hedge funds are making some money on this, although they're taking a whack on their bonds. But that said, since I brought that up, let me talk about some of their strategies. And they constantly evolve, and that's one advantage they have over the huge investment banks. They can really kind of, since it's one individual in a group of investors, and it's not public, they can develop new strategies on a whim. And in fact, they even have one of the 4 strategies event-driven, which means that they can basically plan or get themselves involved in cashing in on a certain kind of event, geopolitical, economic, whatever. Directional is the other strategy I was talking about, where they basically can either short, make a lot of money when everything dips, or they can invest and take profits off the top if things go up. And then there's the global macro, where they basically get their hands in their cookie jars all over the world, including taking credit default swaps out against European debt. And then relative value, which is all kinds of interest rate swaps, currency swaps, that sort of thing. So, and then their business basically involves a lot of cyber financial transactions, which I've talked about is almost science fiction. In fact, I'll attach that video to this so people can find out more background. But essentially, they work with equities, fixed income, futures, options, and swaps. So a lot of that is just kind of gambling in the market. And we have a huge amount of assets handled by some of these hedge funds. Some of the top ones are Bridgewater Associates. They handle $58 billion in client assets. So like I said before, if you have a management fee of 1 to 4% and you're handling $58 billion in client money, then that's going to be a huge amount. And then a performance fee on the money you gamble with from 10 to 50%. Then the second biggest hedge fund, Man Group, at $40 billion. And then we have Paulson and Company and Ziff and Brevin Howard and the like. And people know about some of the other ones, George Soros and his fund management, and BlackRock, the notorious BlackRock. If you need to know more about BlackRock, I recommend you get a hold of Dev Truth. And then there was the long-term capital management debacle back in the 90s that Hank Paulson and Alan Greenspan were involved in, and that was actually bailing out, rescuing a hedge fund. And that's another thing that rubs me the wrong way, the fact that we have these buccaneers, these financial buccaneers, who actually get bailed out by our government. And in fact, 100 hedge funds got loans through the Fed and the Treasury in all the big bailouts. So when you heard about all the bailouts and all the banks, all the hedge funds were getting free money from the Fed as well and using it to gamble in the market. And one example is Front Point Strategic Credit Investments through the TALF program. They went back 48 times for $4.1 billion. So that's one hedge fund that went in, got $4.1 billion free money from the Fed, and then went in and gambled it, leveraged it, dilly-dallied in the market, and probably did well, but I haven't really looked that up. So then we have the background a little bit, while I'm at it, is prototypes of the hedge fund appeared in the 1920s, and it was associated with bucket shops in New York as well. And by 1968, there were 200 hedge funds, and like I said earlier, now there's 4,000 hedge funds, registered hedge funds, and they're not sold to retail investors or the general public, so there's few regulatory oversight. That's one of the other advantages of running hedge funds. You can really do a lot of dirty work without having anybody regulatory commission or oversight. And hedge funds managers are also integrated, and because they have a lot of stake, and that's another reason why we see them playing off each other. And in fact, at the height of the housing bubble, it was the large banks, the too big to fail banks on Wall Street, colluded with these hedge funds to sell these mortgage-backed securities that they were designed to fail. And so there's another example of why hedge funds are financial piracy, because they got together with the banks and made sure that all these mortgage-backed securities with all these crappy, toxic mortgage package, they sold them knowing they were crap to their clients, and then bet against them, bet on their clients to fail, and of course made a killing on that. So if that doesn't tell you that they're all criminals and it's financial piracy, I'm not sure what does. There's been some cases, some relatively spectacular cases, but they've been essentially fall guys, just some token prosecutions. 2009 we had Rajar from the Galleon Group, and then in 2010 3 New York hedge funds were targeted, and now they're going after Stephen Cohen and SAC. And the SAC already had a settlement, just like they always do, with no admitting of guilt. And I'm sure this will work out just fine, particularly since Jack Lew used to work for Citigroup, our new Treasury Secretary, and since Eric Holder's a criminal, of course he won't be interested in prosecuting this too much. So what we have here is hedge funds, and they're essentially built on insider trading. They're built on what is technically illegal front running with high frequency trading. There's a lot of new hedge funds who are getting heavily involved in high frequency trading. We have hedge funds now buying up distressed property, causing prices to go up. And that's where the price increase in housing went from. And they are now the new slumlords. And then they also have planted stories. They're very good about planting stories that cause market moves, and then they cash in on those. And the big one is carried interest, and that's why hedge fund managers also can get very rich, because they're paying some of the lowest tax rates around, somewhere around 15%. When you consider all their offshore accounts, all their hidden accounts, and all their loopholes, I'm sure they're mostly paying next to nothing as usual. So I think that's all I have to really say. I hope I painted a good picture of just how what a criminal enterprise most hedge funds are as financial piracy of our day. And just like the original financial pirates, they're out there on the financial cyber high seas, and anyone is fair game as a victim. And they freelance, and they use all their experience working with government and other corporations and other banks. And like I say, banks collude now. They don't compete in the old school model. Now they collude, and so they manipulate all the interest rates, they manipulate the LIBOR, they manipulate everything. And so to speak of the hedge funds without their connection with the banks, essentially all the CEOs of all these too big to fail banks on Wall Street are essentially the same as the financial pirates at the hedge funds. They just happen to be running a corporate bank, and so they kind of work for the state. So they're part of, like, say, the British Navy, and then the hedge funds are the pirates, and they're actually all good buddies. Kind of like the Republicans and the Democrats. They act like they hate each other, but they're just good buddies. But I digress. So there we have it. Hedge funds. I'm a useful idiot. Don't you be one too.